Hello, and welcome back to another episode. Today we're going to look at some of the recession forecasts and try to understand what's on the horizon and what it could mean for precious metal investors. Stay tuned. Before we begin, please take a moment to like and subscribe to support the channel. Thank you. Recession indicators are still glowing hot, but you wouldn't know it reading headlines from major media outlets like "The case for a 2023 US recession is crumbling." Economists and pundits alike have softened their stance lately, saying that the Fed just might ease us into a soft landing after all. Maybe a recession won't happen, they say, or maybe it will happen in 2024. While opinions have certainly become more fragmented as the Fed's policies and tightening interest rates have caused some fallout in sensitive industries, while the American consumer is being squeezed unrelentingly. And based on some measures, a recession in October seems more likely than a soft landing. Before we get into the data, let's talk about what defines a recession and how they occur so we're on the same page. The Bureau of Economic Analysis, or BEA, is the governmental agency responsible for measuring the nation's GDP. It is measured quarterly and annually, and the quarterly GDP assessment is done on an annualized basis for ease of comparison. It's important to note that GDP estimates responsible for determining whether we are in a recession, defined as 2 quarters of negative GDP in a row, are on a delay. Our second quarter GDP estimates are to be released by the BEA on September 29th. Furthermore, as time goes on, the BEA might collect more data and revise their past estimates. So while some economists have predicted a recession in 2023, declaring one is done in hindsight. You need the better part of a year to get 2 quarters of negative GDP from the BEA. So if a recession really does start in October, as some have forecast, we won't know for sure until late in 2024. So why October? What's going on there? Well, let's look at some of the data. First, there's the inverted yield curve. You might hear this term a lot, and it's referring to Treasury bills. Treasury bills are basically loans that the American consumer gives to the government. The government pays it back with interest. Usually a 3-month loan has a lower rate of interest than a 2-year, 5-year, or 10-year Treasury security. When it's inverted, it means you make more on a 3-month loan to Uncle Sam than on a 10-year note. This has preceded every recession, and it's so consistent that economists have been able to use it to predict the timing of the next recession, and the timing indicates that a recession would be most likely due to begin in October of 2023. Now, pundits who are claiming the indicator must be wrong this time because a recession hasn't happened yet aren't looking at the time frame. Recessions have occurred between 6 and 24 months after a yield curve inversion. So what's driving the yield curve inversion? The Fed tightening rates as aggressively as they have. Rates have never risen this fast before, and remember, the reason they are raising rates this aggressively is inflation. They're trying to reduce inflation primarily by raising interest rates. How interest rates combat inflation is primarily by causing recession. In order to reduce inflation, you have to take money out of the system. Inflation is caused by excess spending driving up demand or by extreme supply shortages. Thanks to stimulus checks during the coronavirus pandemic, we had both of those things. The Fed cannot do anything about supply chains, but they can affect demand. When rates go up, the cost of debt increases. Businesses that live on loans start to crater and job losses follow. The Fed's theory is that with less people employed, spending will slow and inflation will moderate. If this seems shocking to you, it's because it's communicated with a bit of sophistication. There's some obvious concern among policymakers that if they broadcast their intention to harm the job market to cool inflation, they might be in some trouble with their constituents. This is why when Jerome Powell discusses his plan, He describes the job market as unsustainably hot and talked about the need for it to cool in order for inflation to come down. Here's a quote from Powell so you can start to see what I mean. "We've got a demand-supply imbalance in the labor market. It's our job to get to a better place where supply and demand are closer together." Now, what he's saying is we need to raise rates to cause layoffs. That will cool hiring and wage growth and reduce demand so prices go down. If you read this topic on a variety of news sources from Forbes to Reuters to the Associated Press, they very openly talk about this. Now, speaking of Reuters, they reported back in February that it would be necessary for the Fed to cause a recession in order to beat inflation. They looked at an independent study that showed when central banks go to fight inflation, there was no instance in which significant disinflation occurred without a recession. In other words, they caused a recession 100% of the time when examining the data for the US, Germany, Canada, and the UK. When we look for the elusive soft landing throughout US history, there have been 11 attempts to create a soft landing. Studies indicate there has been only one instance in which a soft landing may have been achieved in 1994 to 1995 per Harvard Business Review. So let's take a step back. We know that negative GDP for 2 quarters in a row signifies a recession. The Fed is raising rates to fight inflation and cause a recession. Those two things cannot be separated. And third, the inverted yield curve has appeared whose timing suggests October to start. And there's a bit more. As of September 1st, 2023, student loan payments resumed. Amazingly, economists don't have a model to show what the impact of this is going to be. There's $1.77 trillion in outstanding student loan debt. That's more than auto loans, that's more than credit cards. Only mortgages top that debt. With payments resuming, that's billions of dollars. We don't know how much exactly. That's no longer going into the economy to support businesses. At the same time, we're seeing delinquency rates on auto loans and credit cards are rising rapidly and are currently above pre-pandemic levels. Net savings went negative in the first quarter of 2023, according to BEA data. Multiple outlets are reporting that total savings in American bank accounts has dwindled and almost all excess cash from the pandemic has been spent. And let's take a step back from the data and look at our own personal expenses. A pound of ground beef in my neighborhood used to cost $2.99. You could sometimes get it on discount for $1.99 and on very rare occasions 99 cents per pound. A pack of hamburger buns was $1.99. Today, that same ground beef is $4.99 and the buns are $2.99. What used to cost $5, burgers for a backyard barbecue, is now $8, a 60% increase in the cost of food. A gallon of milk before the pandemic was $3. Today, it's retailing at $5.79 in my local grocery, a 93% increase in the cost of milk over a few short years. Yet the USDA reports that food prices are predicted to increase just 5.8% in 2023. Government data on inflation is dramatically incorrect, and Americans know it. The charts and the data and the history show us that a recession is coming and inflation impact is worse than reported. But more than that, we can look at the world around us and apply some common sense. The average home costs over $400,000. A new car costs on average $48,000. Our utility bills keep going up, our grocery bills keep going up, savings are disappearing, and credit is getting tighter. In 1930, during the Great Depression, the average salary was $4,800. That's equivalent to $88,000 today. The average salary in the US today is $59,000. People make less today than they did on average in the Great Depression, at the start of the Great Depression, while the cost of food, housing, and all basic essentials has increased. It does not take a master's degree in economics to understand that the margins are tight and something has got to give. It's not a matter of if, it's just a matter of when and how severe will it be. Now, before you think I'm turning into Mr. Gloom, let's level set that recessions are a normal part of the economic cycle. It's not something to fear exactly, it's just something to be prepared for. And while the pandemic recession and the Great Recession in '08 are fresh in our memories, it bears mentioning that most recessions throughout history have been much milder than that. So what can people do apart from starting their own gardens and raising chickens? Well, given that we're a precious metals company, we're going to look to our favorite investments to figure out how we can store wealth through a recession. Now, if you're betting on metals, then gold is the favorite to outperform other asset classes during a recession. It has the best track record and performs the best against the stock market during a downturn. Silver is going to be our number 2 choice, keeping in mind that silver has a lot of industrial use. So if a recession hits and industrial use goes down, silver may be impacted. And platinum is what you invest in if you don't think a recession is happening. Platinum is, as of the time of filming this, less than half the price of its all-time highs, and it performs better when the economy is humming along nicely. You do not want to invest in platinum heading into a recession, as it has a poor track record due to how much of its use is tied to the auto industry. So both silver and platinum should experience some tailwinds regardless of the economic outlook due to government spending in green industries, which heavily consume both metals. A more sophisticated investor might decide to hedge by buying a mix of any of these metals. And lastly, it's also worth talking about the purchasing power of the dollar shrinking and how that compares to gold. Gold is often referred to as a store of wealth, and as any fund manager will tell you, money sitting in a savings account is losing value every day. The value of the US dollar has declined about 90% since 1950. The average price of a gold ounce in 1950 was about $40.25. So while the dollar is only able to purchase a fraction of what it used to back in 1950 due to inflation and loose monetary policy, gold has increased in value over 48 times, more than keeping up with inflation. The old saying that you should always be able to buy a suit with an ounce of gold holds true. An ounce of gold today could buy you a very nice suit indeed, just as it could in 1950. By contrast, it was $40 for a suit in 1950, and there are no shops in the US where you could find even a basic suit for that price. As we're discussing recession and inflation, it's an important reminder that gold has a utility that's relevant in today's economy. That's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.